Hey everyone, I'm Cody Charnell. I'm a multifamily real estate broker here in Long Beach, and today we're going to be analyzing a 16-unit building that recently sold here in Long Beach. The goal of the video is to walk you through my analysis and give you a sense of how I look at the numbers on these deals and how you might underwrite a deal like this. I've done this type of video in the past and I've gotten good feedback on it. So I decided to start a new series called How to Analyze a Rental Property. This is going to be episode number 1. And my goal is each week I want to put out a video where I walk you through the analysis on a multifamily property. They'll be of different sizes, so duplexes up to larger apartment buildings. And the goal is to just get you exposure to a lot of deals, a lot of practice kind of running through the numbers, and hopefully get you closer to your goal of investing in multifamily property and building up a big portfolio. If you get any value out of this, please remember to like and subscribe. Also, if you have any deals that you'd like me to analyze, I'd love if you'd send them my way. And without further ado, let's get into it. So let's start with the location. The address of this property is 619 Elm Avenue. You can see it overhead here. So it's 1920s construction, and a lot of people refer to this type of building as a row style building or a courtyard building where there's a central walkway and then you have units on either side. If we zoom out a little bit, you can get a better sense of where it is. So right in downtown, and it's in kind of a sub-neighborhood of downtown called the East Village Arts District. So there's some older kind of historical properties here which give the neighborhood a lot of character. Benefits of being in this neighborhood: you're close to a ton of shopping and entertainment. You're also just around the corner, if I switch it over, it's easier to see, from the Metro line, which is on Long Beach Boulevard. And you're just a couple blocks to the ocean. So tenants who are living in this building could walk to the beach if they wanted to. And the other thing that's happening in this area is there's a lot of new construction. So if we go to Street View, you can see the building here. This is an old photo. It was getting renovated when they took these photos, but lots of new construction happening. So there's a newer building here. If we go down the block, this building has been renovated. It's now called the Partake Collective. So it's like a collective of restaurants. There's a food court downstairs, restaurant condos that different restaurants can rent out, and then shared kitchens upstairs. I've done another video on that, which is kind of an interesting concept. You're close to the grocery store here, and then if we keep going south towards the ocean, you can see there's other new construction buildings here, new construction building there, and really just new construction popping up all over the place. Our subject property is 13 studio units and 3 one-bed units. And in these new construction buildings, you have mostly studio units being built because it's expensive to build. The developers need to be able to rent at a high rent per square foot, so it makes sense to do studios. And what you'll see is studio units in buildings like this start at around $2,300 a month, and they can go up quite a bit from there. So you have this kind of big divide, right? So the 1920s buildings in this neighborhood, like our subject property, studio units might rent out for $1,500 a month, and you have studio units in these newer buildings renting out at $2,300 a month. And what we're starting to see is businesses in downtown are starting to cater to the tenants moving into these nicer buildings. So you have high earning tenants who are moving into the area, and it's kind of pushing up the entire neighborhood. So I think rent growth for our subject property is looking really positive over the long term. If we go down the block this way, you can see just how close we are to the train line. So this is the Metro line. There's a station right there, so tenants can take that train up into LA, downtown LA if they want for work or just for fun. New construction building here. But really overall, a very positive place to be from an investment perspective. If we go back to the building, another thing I want to point out is something that's really common with 1920s buildings is there's no parking. So you have 16 units with no parking. So a lot of people would say, well, what do you expect the tenants to do? And It's really common to see this in Long Beach. You know, in the 20s, less people had cars. There's also a lot more space for, for just street parking. And as the city's gotten more dense, tenants in this type of building have just had to adapt. So tenants are used to street parking. A lot of them will use public transit, so it's good that you're so close to the train line and bus stops and stuff. But this is something that's really common with these types of units. Okay, let's take a look at some property photos next. So when you're looking at properties, they kind of run the gamut as far as condition goes. On one end of the scale, you have heavy fixers, and then on the other end of the scale, you have more turnkey properties. This is an example of something that's closer to the turnkey side of things. So the sellers had done a ton of work to the building, so all new windows, there was new roofs on the buildings. They installed all new main electric panels and sub panels in all the units. 13 of the 16 interiors had been redone. If you scroll through here, you can kind of see what the units look like. But they did new exterior paint, which looks really good. Really clean common areas. There's a laundry room with coin-operated machines, which generates more additional income. And the new security gates, which is a nice feature to have. And here's one of the interiors that they kind of converted to be more open concept. So you have flush lighting on the ceiling, more modern kitchen with quartz countertops, bathroom, back through that door. And overall, really clean units, vinyl plank flooring. There's your bathroom. Yeah, overall, these units tend to be about 350 square feet. So you'll see a lot of this almost exact same building all throughout Long Beach. And studio units are right around 350 square feet. So for a unit like this, market rent is right around $1,500. You can get a little bit more than that if you do really nice upgrades like this one. Overall, something that's going to be easy for a buyer to take over and just start managing. They don't have to worry about big projects. So, all right, so now let's take a look at the numbers. Asking price on this deal was $3.45 million. And one thing I didn't mention that really makes this one interesting is the financing. So the current owners in 2019, they refinanced into a 10-year fixed loan at a 3.82% interest rate. And at that time, it was important to them that the loan is assumable. And it turned out to be a really smart thing for them to do because now they're selling this building with an interest rate that is impossible to get in this market. So the buyer who ended up buying this property did assume the loan at that low interest rate. The loan balance was $1.923 million. And so their down payment required was just over $1.5 million. If another buyer wanted to buy this and not assume the loan, they would be looking at a 6.3% interest rate, which is right around what rates are at today. And most banks right now are requiring borrowers to hit a 1.25 debt coverage ratio. So debt coverage ratio, if you're not familiar, is it basically says that you have to have $1.25 of net income for every $1 of mortgage payment. So they're forcing you as the borrower to cash flow. So they're making you put enough down so that the property's cash flowing. So if a borrower wanted to use that same interest rate, with that same down payment, they would be just hitting the bank's requirements. So really, you're going to need the same down payment whether you assume the loan or not. So in this case, it was a huge benefit for the borrower to be able to do that because their rate was 2.5% less by assuming the current loan. Down here you can see the unit mix and rents. So 1-bedrooms right now are rented between $1,695 and $1,750. And studios here are renting anywhere from $1,225 a month up to $1,550. And this column's all our current rents. These are our market rents. So for 1-beds, we're saying market rent is $1,850 a month. And for studios, we're gonna say $1,550 is market rent. We also have some laundry income down here. So Total current rent is about $24,000 a month, a little over 24, and you can increase rents and get that monthly gross rent up by about $1,500 a month. So there is a little bit of upside on the deal for the new buyer. So looking at the metrics, so the property is 6,379 square feet. So the borrower or the new buyer is paying $541 a foot, which looks high relative to other properties that may have sold, but because the building consists of mostly studios and studios rent for a high price per foot, it's common for buildings like this to trade at a higher price per foot than, like a building with all 2-bed units, for example. If we look at gross rent multiplier, so gross rent multiplier is comparing our price to the gross rents that the property generates, and based on the current income, it's priced at 11.89 times gross, which is right in line with comps. So if you've been tracking properties in the 5-unit and up space, you know that pricing has been decreasing. And the reason that's been happening is people who purchase properties, let's say back between 2020 and 2022, when rates were really low, their interest rates were fixed for usually 3 or 5 years, and a lot of those loans have started to adjust. So some people are being forced to sell because their mortgage payments are increasing drastically. It's also a lot harder for people to buy commercial properties because interest rates are higher. So you see a lot of deals like this where it's necessary to come in with a 40, 50, even higher than that down payment. So that cuts out a lot of people who may have wanted to exchange and re-leverage their money, or who just had new cash to purchase a property. So what's great about this deal is that you're buying at a gross rent multiplier that's less than it was a couple years ago, and you still get the same interest rate from a few years ago. So you're getting kind of the best of both worlds, so better pricing, but still low interest rate. So the pro forma here has some estimates for expenses. So we have taxes, insurance, repairs and maintenance, property management. One note on property management: because this building is over 15 units, you are required to have an on-site manager. So if we go back here, our property management expense is 8%, which is higher than you would typically pay. Like usually I'm using 5 or 6%. 8% is what the bank will use to do their analysis because this is over 15 units. So 8% includes the expense for the on-site manager. And then you have just kind of basic other utilities or other expenses like utilities, pest control, gardening, and all the rest. And so this spits out our cash flow based on current rents and our cash flow based on market rents. Based on these expense estimates, the property is selling at a 5.2% cap, and you can increase rents and get that to operate a little bit better, so you can get it down to get it up to about a 5.6% cap rate, which is really good. Properties a couple of years ago were trading in the 4% range, so cap rates have increased pretty substantially. And looking forward a few years, it's expected that the Fed will cut rates at some point. So once rates start to go back down, we expect cap rates to go back down as well. So that means prices will increase as rates go down. So I think from a timing perspective, this one is really interesting. 5 years left on that really low interest rate loan. And we're expecting rates to drop a bit. So there's hopefully going to be a bump in property values because rates come back down. Once the loan does go adjustable, they'll hopefully have an opportunity to refinance at interest rates that are lower than where they are today in 2023, 2024. And, they're going to be cash flowing well while they hold the property, and they'll be able to take advantage of, just market appreciation. There's tax shelter benefits, so they'll get to depreciate the value of the structure, and then they'll have some principal pay down. So, in total, when you combine those 4 elements of return, so appreciation, cash flow, tax shelter benefits, and equity buildup, This property is returning almost 20% in the first year. So not bad returns for this deal. And especially for something that's turnkey, it's going to be easy. You just kind of buy and hold and operate it as a long-term investment. All right, so hopefully that gives you some insight into how to analyze a property like this. Like I mentioned before, I was able to help my clients get this one into contract before it hit the market. So I come across deals like this all the time. So if you're interested in properties like this, please reach out to me. It's always great to have investors to be able to send this stuff to. Again, this is episode 1 of the How to Analyze a Rental Property series. So if you got value out of this, please like and subscribe and tune in next week for episode 2. If you have any deals you'd like me to analyze, please send them my way. And remember, invest well, trust Cody Charnell.